dancing the jig based on those numbers. What was most interesting to you?
Well, it was pretty much across the board a better report. The headline was better than expected. The core, which is ex-food and energy, was better than expected. Most of the component parts, in particular the rent component of CPI, and then an imputed version of that called owner's equivalent rent, really has started to come down, and that has been one of the stickier areas. So it was pretty much across the board stronger than expected. And on the same day, we got better than expected unemployment claims readings too. So that brings both of the Fed's mandates of their dual mandate into sharper focus. And it was just a Goldilocks kind of day.
And in response, investors bid up stocks. All stocks, including small caps and others that haven't been doing very well. Is it time to jump into that area?
Well, I think you still have to stay up in quality. I think the reaction day to this better CPI report, everything that hadn't been working worked that day. And there was a little bit of a lower quality bias to what worked. But I would say that beyond just the very, very short term, if you're looking for opportunities amid the under the surface weakness and rotation that has happened, you still want to stay up in quality. So looking for companies, stocks of companies that have strong balance sheets, that have ample interest coverage, that have strong free cash flow, that have profitability. So that's the way to approach the market when you're moving away from just what had been the small handful of names lifting performance to such a degree.
So that's a point you've been hammering home, and maybe you can explain that a little more for viewers. So everybody thinks the Mag 7 have been the ones driving performance, but it's actually those quality stocks, and you've pointed out that the dispersion between the performance of those really high quality stocks and the lower quality has been enormous.
Right. So I think there's some conflating that happens when we talk about, let's use the Magnificent Seven as a group because it's got so much popularity, that they are the biggest drivers of performance for the cap-weighted indexes like the S&P 500 or like the NASDAQ. But it's not solely because of their price appreciation. It's price appreciation times their market cap, which means they're 7 of the largest contributors to performance. But they're not the 7 best performing stocks. The top 10 best performing stocks within the S&P, only one of them is also in the Magnificent Seven. And that's maybe no surprise, NVIDIA. And that's not even the number 1 best performer. There's actually 2 utility stocks in the top 10. So from a price performance perspective, there are other stocks that have done well. GE is in the top 10. Talk about old school. It's just when you have that multiplier of large cap, they become large contributors. So there are opportunities that have been in the market. It's just been a tough environment for institutions that are benchmarked to these cap-weighted indexes.
So you and I may be the only people on television not talking about the presidential race right now. So let's jump to that real quickly. You have an interesting point to make when it comes to how much investors should worry about what's going on in Washington, what will go on in Washington. I think we even have a chart from you about that.
Yeah, so short term, it's likely to be a volatility driver. I think that's sort of the ultimate understatement, given that volatility in the market has been so low that at some point the path of least resistance becomes higher. So I do think we're likely to see some volatility as we get closer to the election. But the real way to think about elections and an impact on portfolios is that chart you showed. And we went all the way back to 1948 and looked at the growth of $10,000 invested in the beginning of 1948 and what it grew to by the end of 2023 if it was only in the market when a Republican was president. Well, that 10,000 grew to about 300,000. I'm using round numbers here. If you had only had it in the market when a Democrat was in the White House, it grew to 1.2 million. Shame on anybody that stops the analysis there and says 4 times better performance under Democrats in the White House versus Republicans, because if you had just kept the money in, this is simple buy and hold strategy, but if you just kept the money in, the $10,000 had grown to 38 million. I don't know about you, Jack. I'll take the 38 million.
I will take the 38 million every day of the week. Thank you, Liz Ann Sonders. That's great advice. It'll be hard for people to believe it over the next couple of months, but they got to stay strong. Thanks for coming on the show.
That's right.